Okay, my name is Rachel Gustafson. I am a certified financial planner here at Financial Investment Team. We're a woman-owned and run firm, and we specialize in holistic financial planning and financial education. So normally we offer monthly in-person seminars and classes on various financial education topics, like the Secure Act. Due to the coronavirus and social distancing, we have moved to a virtual setting and we're embracing this world that we're living in right now. So my goal is always to inform and educate you so that you can understand how critical financial planning topics affect you and your family. All right, so today we're here to learn about the Secure Act. I'm going to do a quick poll, and it's a very simple question. Are you familiar with the Secure Act? So I'm going to launch this for you. So yes, very, somewhat, and maybe never heard of it. Just gives me an idea of where we're all at today. Great, yeah, so it looks like a good majority of us, 57%, somewhat. I'm going to go ahead and close it. Somewhat know about the Secure Act, and about 47% of us have never heard of it. Great. So we are going to go over quite a bit today. We're going to focus on how it affects your retirement specifically. The Secure Act was signed into law December of 2019. There is a lot of legislative limbo, and believe it or not, it's the biggest retirement-related legislation in over a decade. Had bipartisan support. Congress realized that retirement rules needed to be updated. And so today's topic, of course, is the Secure Act and the changes that it brings, particularly to retirement rules. So let's start off by looking at the core challenge we're all facing. The Secure Act changes the retirement rules for individuals and companies, which means current and future retirement plans need to be reviewed and adjusted. Funding your retirement is likely one of the biggest financial challenges you will encounter in your entire life. You start your career, you buy a house, maybe you start a family, have children, send your children to college, and then somehow you need to have enough money to live for 20 to 30 years without a paycheck. That can be enough to make anyone stressed. So as if that weren't enough, the government has all sorts of rules about how you can save your money, when you can or can't take money out. Sometimes there's a penalty for withdrawing money before a certain age. Sometimes you have to withdraw funds even if you don't need them and would rather they stay invested. A lot of people don't know enough about these rules, and so they can make mistakes which hurt their financial plans. Not to mention the idea of retirement is changing. The boomer generation is going into retirement, and many have not saved enough money to live comfortably. Lifespans are getting longer. People are putting off retirement, whether because they want to or because they have to. Younger generations pull income from multiple sources and jobs throughout their lives. So the old rules aren't necessarily applicable anymore. These are the driving forces behind the Secure Act. No matter where you are in your retirement savings, current and future plans need to be reviewed and adjusted. So I always like to start off with taxes. Everyone's tax situation is different. You should always consult a qualified professional tax advisor to discuss your specific tax situation, especially about these topics. Traditional IRAs, Roth IRAs, you're going to hear me mention federal taxes. You may still face state taxes. You always want to check with your tax professional. And I want to be really clear, I'm a financial planner. I don't provide tax advice. We have a CPA on our team that provides tax advice to our clients. This webinar is really meant to be educational and help you become aware of some of the changes. So what is the impact? Well, it's far-reaching from the silent generation and boomers who are thinking about estate plans to boomers and Gen X focused more on retirement. to millennials and Gen Z, who will be the recipients of a great wealth transfer in the next few decades. Like I said, everyone needs to reevaluate their financial plans. Taxes are more complicated than you might realize and a key part of your savings, investments, and retirement plans. If you don't plan ahead, you will miss out on saving opportunities and possibly pay more taxes than is necessary. When we're working with our clients through retirement planning, tax planning is a huge piece of that and one that can often be forgotten. In addition, the government sees businesses as having a continued and expanded role in promoting retirement savings by their employees. So I just want to make sure that you understand the changes that will impact you, your family, and if relevant, your business. So we're going to start with business, which leads us to our second poll. And this just gives me an idea of who we have in the room with us today. The question is pretty simple. Do you own a business? And I'll give you all just a second to complete that. Okay, I'm going to close it out. How funny. Half of us own a business and half of us do not. This is good to know. So, whoops, sorry about that. Skipped right ahead. You may be thinking, I don't run a business. So how does this aspect of the Secure Act really relate to me? It's a good question. So we're going to talk about both sides. The workplace is where retirement saving begins. So these new rules are important to everyone. The Secure Act is about promoting better retirement savings, so there's a clear role for employers. So our first key is businesses have more incentive to create retirement plans and promote greater participation by their employees. So let's take a look. According to the US Census Bureau, 98.2% of American employers have fewer than 100 workers. So this is how the IRS defines a small business. And this is the next item. So this next item is a lot more important than it might seem. Congress is authorizing more help for small businesses in the form of tax credits. So small businesses who start a retirement plan can now claim a credit of up to $5,000 for up to 3 years to help with those startup costs. This is a substantial increase from the previous $500 credit that was available. In addition, small businesses who opt an auto enrollment retirement plan, which we'll talk about shortly, can claim another $500 for 3 years, separate from the credit that I mentioned above. This applies not only to brand new retirement plans, but any existing ones who adopt the auto enrollment option. So hopefully these tax credits are going to encourage more employers to offer retirement plans, which in turn allows more Americans to save. So what is that auto enrollment program? So in an effort to encourage and increase retirement savings, some employers are using this in their 401k plans. So it simply means new hires are automatically enrolled in the plan and they must opt out instead of opting in. So think about your paycheck and you have health insurance come out of your paycheck. That automatically happens. You just don't think about it. That's kind of the idea around this auto opt-in for 401ks. If it started right in the beginning and you're not thinking about it and your employer is increasing it for you without you even needing to do that, we're hoping to increase retirement savings by doing so. So studies have shown that auto enrollment is increasing 401k balances. So Congress wants to continue the good work. Companies that auto-enroll can slowly increase the percentages saved each year automatically, unless the employee opts out, once again. Previously, 10% of a salary was the maximum that could be automatically deferred, and now employers can set that default up to 15% of an employee's salary. So if you start with a job that has the auto-enroll feature, you need to actively opt out if you don't want it to happen. This is a really great time to look at your own 401k savings and consider if you're saving enough. Is that the right place to put your retirement savings? And how much is your employer matching? A good rule of thumb that I use with my clients is every year increase by 1%, close to when you get a raise, so you almost don't even notice it happening. Another change that came about, companies have more freedom to offer annuities inside of 401k plans because the Secure Act reduces risk to employers. So before, plans avoided this because as investment options, they feared that the annuity carrier might go out of business and the plan would then be held responsible. So the easy way to explain the change is that a safe harbor was created. And as long as the plan provider does due diligence in selecting the annuities that they provide, they won't be held liable. So why is this important to you? One of the hardest parts of retirement income is making your lump sum savings last throughout your life. Annuities are insurance products designed to turn a portion of your savings into a lifetime income stream. So you might want to consider using some of this in your 401k savings to purchase one of these insurance products if it makes sense. Annuities can be complicated and expensive, so this is definitely something where you want to get some advice as to whether this makes sense for you and your situation. But it is also something that you may start seeing offered through your 401k plans. So our next point is somewhat related to annuities. Employee 401k statements must now include a lifetime income disclosure. So instead of what you normally see, which is your current lump sum amount, for example, you have $50,000. And $50,000 doesn't tell you a lot, doesn't tell you about how much you can expect to receive monthly when you do retire. Well, now they're going to have a disclosure that gives you an idea of what that amount might be. The ability to see how much savings would then be translated into a monthly income stream will hopefully help you save. You'll see that lifetime income disclosure at least yearly in your 401k statement. And we're hoping that it wakes some people up. You look at it and you think to yourself, either, yes, I'm on track, or no, that's really not going to be enough. And so what do I need to do? Of course, it's impossible to know how long your retirement will last. Everyone retires at different ages, but these new disclosures will hopefully give people an idea where they stand in terms of saving for retirement. If you haven't seen it yet on your 401k statement, you can reach out to your 401k provider to see when you might see that or where to look. So the last point about having an income stream in retirement may strike a chord and prompt you to ask, what key items in the Secure Act will specifically impact me and my plans for retirement? So here's the answer and our next key. You now have more time to save for retirement, more ways to save, and more ways to use the funds. So let's take a look. So first, there is no maximum contribution age for individual retirement accounts, or IRAs as we call them. Investors may continue contributing to a traditional IRA as long as you have earned income. Previously, you could only contribute until age 70 and a half, and then at that point you would be forced to start withdrawing from the account. But as more people continue to work past age 70, we're seeing lifespans increase. It makes sense that people want to contribute to retirement accounts for a longer period of time. You can now continue to do that as long as you have earned income. So I mentioned earlier that in the past, savers were forced to withdraw money from their IRA starting at age 70 and a half. Well, those withdrawals were called required minimum distributions, or RMDs for short. The Secure Act pushes those forced distributions to start at age 72. I will make a note here, due to the CARES Act updates, there are no required minimum distributions for 2020. And the CARES Act, we're keeping a close eye on it because it can change at any moment. But for this year, if you were required to take an RMD, you are not required to take one this year. But normally, and going forward, it will be age 72. So what does this do for you? This gives your money 18 more months to grow tax-free. However, building up large IRAs means larger RMDs in the future, which can have tax consequences when it's time to start drawing down your retirement assets. So this is one of the topics. I will be offering a complimentary 1-hour meeting to come in and talk about your specific situation. And this is a great place to look at and see what makes sense for you. Now we have some good news for part-time workers who also want to save for retirement. Employers with a 401k plan must allow employees who have worked at least 500 hours for 3 consecutive years or 1,000 hours throughout the year to contribute to the plan. So this is especially good for some parents who may be working part-time for caregiving reasons, as they often have fewer retirement savings. However, I'm sorry to say this new legislation applies to plan years beginning in 2021, but the employer doesn't have to start counting the 500 hour per year until 2021. So employees might not be eligible until 2024. If you are a part-time employee, I encourage you to check with your employer to see how they will be handling the new rules. Okay, another quick poll for us. How old do required minimum distributions start? Not taking into consideration the CARES Act, but going forward. Okay, it looks like most of us got it. So the new age is 72, no longer 70 and a half to start required minimum distributions, except for 2020, which the CARES Act is not requiring this year. And then a quick note on the CARES Act, I'm going to be hosting a webinar next week to talk about some of the changes the CARES Act brings. It can be kind of confusing because we had the Secure Act that started right at the end or beginning of 2020, and then the CARES Act, which also came into effect this year. So there's been a little bit of confusion on the overlay of the different laws. So hopefully next week, the CARES Act webinar that I'm hosting will clear some of that up. So this next rule change deals with how you take money out of your savings plans. The new parents may each withdraw up to $5,000 penalty-free from a retirement account for a qualified birth or adoption. Normally, there is a 10% early withdrawal penalty for people under the age of 59 and a half. So to meet the requirements, the individual must take a distribution from the retirement account within 1 year of either the date of birth or the date on which the adoption of an individual under the age of 18 is finalized. So even though there will be no penalty, you may still owe taxes on the money withdrawn. Of course, it means less savings for retirement. So you really want to be sure to talk to your financial advisor to see if withdrawing the money is a good plan based on your overall financial plan. And quick note, CARES Act has changed what you can withdraw with avoiding the 10% penalty. So this is not applying to that. Not only can older workers continue contributing to IRAs, but more younger earners can start contributing with an expanded definition of earned income. Stipends and non-tuition fellowship payments to graduate and postdoctoral students count as earned income now. And that means that students can contribute to IRAs where they may not have been able to previously. This is good news for students who want to begin accumulating tax-favored retirement savings. In many cases, graduate study keeps them too busy for a job that might offer a 401k or other employer savings plan. So that was kind of the reasoning behind this, was giving students the ability to start contributing to a plan for retirement. So this rule change doesn't actually have to do with retirement accounts, but it is something that may help more people be able to save for retirement. Investors who have a 529 education savings plan can now withdraw up to $10,000 to repay student loans. So you might be thinking, why would I have student loans if I have a 529? It could be that for whatever reason you couldn't use your 529, or you inherited it, or maybe the funds in your 529 were left over from when you went to school and you didn't need them. I've seen some strategies where clients have a spouse and they transfer their 529 to that spouse so that he or she can pay off a portion of their student loans. So there's some strategy that can be used for this. We all know that student loan debt is a crisis in America. Hopefully this new provision will bring some relief to savers and allow them to put less money towards student loan debt and more towards retirement savings. A related change is that 529 plan monies can also be used for apprenticeship programs, as long as those programs are registered with the Department of Labor. So some kids don't go to college or university. My brother went to a trade school, but you can still use that money to finish your education. And you can use the 529 plans that your families may have built for you to do that. And in case you didn't know or had forgotten, the Tax Cuts and Jobs Act of 2017 also broadened the use of 529 plans, so that now you can use $10,000 per year withdrawal to cover private K through 12 education. There's been some changes to 529 plans. Okay, another quick poll for us. How much can you use from your 529 for student loans? Looks like most of us got that. $10,000. Very good. You can use up to $10,000. Okay, undoubtedly, there are some of you in the audience who have already accomplished saving enough for retirement. Kudos to you. Now you're starting to think about the next generation and estate planning. And you might be wondering, what do we need to know about leaving our IRAs to our kids? Is that still allowed in the new rules? Let's take a look. Unfortunately, the news here isn't so good. Our third key point is your kids can still inherit your IRA, but they can only defer taxes for up to 10 years. So not only are your retirement savings affected, but the death of the stretch IRA requires a review of your estate plan thinking. So it used to be that your beneficiaries could inherit your IRA and stretch it out over their lifetime. That is no longer the case. It now needs to be used within 10 years. With certain exceptions, which we'll see in a moment, beneficiaries of IRAs, like I mentioned, must liquidate the accounts within 10 years. Previously, they could stretch it out over their lifetime. Some heirs even plan to use the accounts for their own retirement, but now they must take out the money within that 10 years of the death of the original owner. This could have major repercussions for the beneficiary. When you withdraw that money, you have to report it on your income tax and pay taxes. This could also affect the FAFSA if you have children applying for college financial aid. and possibly limit your ability to claim certain tax credits. So there's no rule about how you draw down the account as long as it's gone within 10 years. So you could take out some each year for 10 years or none at all for 9 years and then everything in the 10th year. Planning is definitely needed, and this should really include consulting your tax accountant. If you have a large IRA balance, a note will be part of your estate. Note that on your meeting request, if you sign up to have a complimentary meeting with me, and we can talk about some of the different strategies that you can use as well. So there are some exceptions to the 10-year rule, or what the IRS calls eligible designated beneficiaries. They include surviving spouses, disabled or chronically ill beneficiaries, those who are not more than 10 years younger than the original owner, and minor children. In that last case, the 10-year clock starts when they reach the age of majority, which tends to be 18 or 21, depending on the state you live in. Doesn't include grandchildren or other relatives of the original IRA owner. So if it's left to minor children, when they each reach the age of majority, that's when their 10-year clock starts. For all of these eligible designated beneficiaries, the stretch IRA is mostly business as usual. The new rule also does not apply to people who have already inherited an IRA. It's only those that inherit in 2020 or later. And so this brings about definitely having a look at your estate planning efforts. If part of your plan was to leave your IRAs to your children, you definitely want to have that review to make sure that that is in your best interest and the best interest of your beneficiaries. So the real lesson from all of these changes, particularly the death of the stretch IRA, is that tax planning is more important than ever. Congress is looking for ways to increase revenue, and one way to do that is to eliminate tax breaks. So we may see other changes before the time comes for you to retire or pass on your estate. For many years, even decades, people were told to rely on IRAs, and many Americans listened, to the point where, helped by a 10-year bull market, they have a lot of money invested in these tax-deferred accounts. The problem is, one day the tax bill will come due, and you can't predict what the tax law will be when it does. As I've said, I'm not a tax professional and I don't give tax advice. All tax decisions should be reviewed by your accountant, but I can help you look at your investments and savings and help you plan ahead. Taxes in retirement are a much bigger issue than many realize, and we can help you develop a retirement income plan so that you can draw down your accounts in a tax smart way. Some of our strategies might include Roth conversions, managing your tax brackets, reviewing your beneficiaries, including trusts, and creating an estate plan that makes sense for you and for everyone in your life. So really, really just important, and what we're trying to reiterate here is to have your retirement plan reviewed by your financial advisor, or take advantage of the complimentary session that I'm going to offer at the end, and you can answer any questions that you might, I can answer any questions you may have about your personal situation, but it really depends on you and your personal situation. Hopefully, I've conveyed to you the importance of the new retirement rules brought by the Secure Act. And you can see that this legislation is something that actually affects your life. You're probably wondering, what are my next steps? First, let's look at the key points we've covered today, because we've covered quite a bit. The Secure Act changes the retirement rules. So we started our presentation by saying the Secure Act changes the retirement rules, and that means current and future retirement plans need to be reviewed and adjusted. Our first key point, businesses have more incentive to create retirement plans for employees and promote participation. And so hopefully, if you are an employee, you are able to take advantage of a retirement plan with your employer. And if not yet currently, hopefully that will be coming down the pipeline soon for you, especially with Oregon Saves. Oregon has taken it upon themselves to really have businesses implement retirement plans. Our second key point, you now have more time to save for retirement, more ways to save, and more ways to use the funds. And then the third and final key point, your kids can still inherit your IRA, but they can only defer taxes for up to 10 years. And so that key point there is going to change a little bit about how you leave your assets to your children. Okay, that was a lot of information that I covered in a short amount of time. Sure, you may have questions. We'll get to those in just a minute. So everyone's situation is unique. It requires a personal discussion. That's why I'm inviting everyone to meet with me individually. If you're already a client fit, we'll make sure we get you with your advisor. And if it's with me, think of it as a thank you for taking the time today during your lunch, probably. Hopefully you're able to eat lunch while you're listening in to attend one of my workshops. Gives you an opportunity to address some of your personal questions or concerns about retirement and taxes. Once you do leave today's webinar, you're going to be asked to complete a short survey. Please take a couple of minutes to complete it. I use the information to change webinars going forward, to make tweaks, there's a question that asks, are there topics that you're interested in hearing about? Especially right now while we are all working from home, webinars are something that we want to offer on a weekly basis, and we want to do it with information that's important to you, topics that are important to you. So that is one of the questions that you'll see today, and I encourage you to fill in if there is something that you would like to hear about. Let's see here. So the one big piece that I want you to walk away from today is revisit your retirement plan, have it reviewed, take into consideration these changes. Next week, I'm talking about the CARES Act because there are additional retirement changes that the CARES Act has put into effect for 2020. And so I'm offering a complimentary financial check-in so that we can get together. It will be virtually to talk about your questions and how this may affect you. And let's see if we have any questions.